All right, a tariff-driven sell-off. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Danny Berger. Katie Greifeld and Sonali Basak are off today. Bloomberg Open Interest starts right now.
Coming up, tariff threats. President Trump announces a 50% tariff on EU goods starting June 1st. And the president targets Apple again, threatening a tariff of 25% if iPhones sold in the U.S. are not made here, which would be obviously very few. Plus, these threats fueling a fresh sell-off as the S&P heads for its worst week since the start of April, since Liberation Day, Danny Berger.
Goodbye any hopes you had of a quiet Friday ahead of the long weekend. Here we are, one of the stocks to watch, as Matt mentioned. Apple facing more pressure, down 3.25% from Trump, facing that pressure of more tariffs, with analyst Dan Ives saying made in America iPhones would triple the price.
Triple the price. Not of the stock.
No, of the iPhone.
Of the iPhone.
$3,500, something like that for your iPhone.
Whatever, we can afford it, I guess, if it's paid on a monthly basis. Retailers are falling after pulling guidance on macro uncertainty, which stems from Trump's tariff barrage. You can see Ross Stores right now down 14%, and Deckers Outdoors, which makes Uggs and Hokas, losing a fifth of its value, Danny.
Matt Miller not buying enough Uggs to support Deckers. All right, back to our top story. This weekend marks the halfway point of President Trump's 90-day pause on tariffs in order to strike deals. Now, while trade negotiations are underway with several countries, Trump has signaled that talks won't lead to agreements for every nation before the July deadline. And this morning, he said that the European Union talks are going nowhere and will implement a 50% tariff on the bloc starting Sunday. Bloomberg political reporter Tyler Kendall joins us now from the White House. Tyler, we are supposed to have negotiations with Jamieson Greer and his counterpart in the EU. How does this set the scene?
Yeah, hey, Danny, it's definitely setting the tone ahead of those planned talks that were still expected to happen between the EU's trade chief and USTR Jamieson Greer later this afternoon, as President Trump says that ultimately there's been no progress made when it comes to talks with the European Union. Now, we should note that Bloomberg News has been reporting that the EU floated to the U.S. earlier this week a revised proposal that would see both countries gradually lowering their tariffs down to zero on certain agricultural products and industrial goods. It does not appear that that was enough to move the needle in any way for the U.S. And of course, as we've been, discussing on Bloomberg Television, there's a lot of different complicating factors here when it comes to striking a deal with the EU, including that they are negotiating as a bloc, so all 27 member states have to agree on the ultimate end goal here. And that can make things particularly complicated when it comes to addressing some of the White House's top priorities, like those non-tariff barriers that they talk about, such as the VAT tax or digital services taxes.
Right. We should be clear and point out that the VAT tax is in no way a non-tariff barrier because, and I'm not sure if anyone's explained this to President Trump, European manufacturers pay the VAT tax as well. So that would be like calling New York state sales tax non-tariff barrier. Everyone has to pay that. It's just a simple tax on sales, which is like what we have here in almost every state. In terms of the 50% tariff that Trump wants to put on, he says June 1st. Does that mean it's going to happen, or is this just leverage for talks?
Yeah, well, Matt, as you know, of course, there is so much uncertainty, as always, particularly when it comes to that timeline. We're going to have to see how the EU ends up responding to that threat. As you know, they had some planned retaliation worth about $107 billion in response to the sector-specific tariffs that have gone into place and have hit the European Union particularly hard, like steel and aluminum and also autos. And they were gearing that towards some of those key U.S. industries that President Trump has sought to protect, like U.S. agriculture. So that's going to be a very key sticking point here, whether or not there's some sort of threshold here where the U.S. would potentially back off of this tariff threat.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting live from the White House. I should point out there are 5 states without a statewide sales tax.
Is Delaware one of them?
I think Delaware is one. Yeah, Alaska, Delaware, Montana, New Hampshire, and Oregon. But even in those states, you may have a local sales tax, like a city sales tax. So if you're charging VAT in, for example, Germany, BMW, if you buy a BMW made in Germany, you have to pay VAT. If you buy a Porsche made in Germany, you have to pay a VAT. So anyway, just to clear that up, and if anyone's listening from the White House, that's not a non-tariff barrier. Later this morning, Bloomberg is going to sit down with Treasury Secretary Scott Bessent. Maybe David Weston will whisper this in his ear as well. That's at 11:30 a.m. New York time. Let's get more details on the Apple story that we were talking about. Analyst Dan Ives says Made in America iPhones would force Apple to charge more than $3,000. And then, of course, in New York, you'd have to pay the extra
sales tax.
And a half
or if you
percent
buy
sales
it from,
tax.
If you buy it from the EU, then you got to pay a VAT tax too.
Another 20% there. Bloomberg Technology co-host Caroline Hyde joins us now to talk about this. So President Trump had given Tim Apple a reprieve, and now he's saying, look, you got to make these iPhones here.
And it wasn't even a reprieve for long, because we've heard him being the line of fire for the last week or so, calling out Tim Cook not being there in Saudi Arabia, remember? Saying he had a little problem with Tim Cook about the amount of manufacturing that was shifting to India. And now he puts it plain and clear on his own social media account, saying you will be charged 25% tariff if you don't start moving your manufacturing to the United States. Enough is enough, but you just had Dan Ives saying, look, this is how much it's going to cost to build an iPhone in the US. They're calling it a fairy tale. They're calling it frustrating. You've got absurd being words thrown around by the analysts at the moment. This is going to be a big stomach cost in terms of margins. Whether they're paying the 25% tariff to import them from China or India, well, that's going to be about a margin hit of 300 to 350 basis points, so says Bloomberg Intelligence. And more broadly, this is impossible in the next 3 to 5 years. You need the labor, you need the skills, you need the ecosystem. This is going to be some tough negotiating for Tim Cook, who is very political in many ways himself.
Which, by the way, if it's 3 to 5 years, who's to say Trump is even the president by the time that they achieve that goal? And doesn't this come at the worst time? Hasn't the FT just been reporting that they were doubling down on moving production to India?
And maybe that's what sparked the anger coming from the Trump administration, that even though he singled out Tim Cook for putting all the manufacturing in India, it seems as though they're still going ahead with it. They need to go ahead with it because they need to diversify. This hasn't been overnight that they've shifted to India. This has been years, decade in the making, going from China to ensure that they can build in Vietnam, in Thailand for your AirPods, make phones in India, but they've had to build up the ecosystem of suppliers. This is why you're seeing the suppliers get hit, as well as Apple in pre-market trading, because they're ultimately worried about how hard this is to navigate this to the United States, to get the right labor force, and ultimately the amount of price points that we're going to drive up. But at the moment, they had been doubling down on India manufacturing because it looked as though tariffs were likely to be lower in the longer term from India shipping to the United States. That's a lot of phones they're going to have to make in the United States, and that's going to cost a lot of money.
We're going to start to see those memes again of everyone in their Wall Street vests at the factory making the iPhones.
I can't wait for my daughter to get a job in the iPhone assembly factory.
So your daughter should study engineering, so not the worst idea. Caroline, thank you so much. Bloomberg Technologies, Caroline Hyde. All right, let's look at some earnings that we've got, because that's making waves too. Retailers Ross Stores and Deckers, not putting this out, both falling after the companies pulled their full-year guidance due to macro uncertainty. Dana Tesley of the Tesley Advisory Group downgraded Deckers today. She spoke to Bloomberg earlier this morning.
You've seen some companies being able to withstand the shock, whether it's a Ralph Lauren and a Tapestry. Brand leaders are making the difference with product innovation, but most others, the impact of tariffs is uncertain in terms of the magnitude and also the acceptance of price increases by consumers, because at the end of the day, retail is going to have to raise prices with these types of tariffs.
For more on retail, we are joined by Bloomberg earnings specialist Red Brown. Great to see you this morning. Look, it's not all retailers that have reported negative earnings. Some, like Walmart, still have strong demand. How much of this is a Deckers and Ross problem versus a consumer problem?
Yeah, no, that's a great point. Some analysts this morning actually pointing to Deckers might actually be just shifting into kind of a lower growth period for the company. You know, Hoka and Uggs have been big winners over the last couple of years. You know, you see them on everyone's feet, really, when you're walking around the city here. But it just might be kind of bad timing for them to kind of be decelerating just slightly.
In terms of eating the tariffs, which is what President Trump wants these retailers to do, how fat are their margins? I mean, when you look across the earnings spectrum, and I know you cover a wide range of industries, but retailers, what are they making, and how many can really afford to eat up these tariffs?
Well, they're typically operating at much lower margins than maybe, like, you know, obviously software companies, things like that. You know, Ross is around like 25, 30%. for example. But again, think about who their customers are. For Ross Stores, their other brand is called DD Discount, right? So it's people that are looking for to get high quality goods, but they're looking to do so at a much lower price point. So these aren't people that are going to be, these are people who are particularly sensitive to price increases. So not working with a lot of leverage at the moment.
Well, the phrase that Matt said, eat the tariffs, came directly from President Trump, directly after we got those Walmart earnings. When we hear from these companies, how difficult is it for them to navigate when they know that their earnings call might be dissected by the leader of the free world and might get a direct response to it?
Yeah, right. No, everyone's talking about uncertainty, right? But I think we got a great example of it today. Like when we say uncertainty, it's a tweet, it's a post, it's whatever, what have you. So yeah, they're having a very difficult time navigating just like the PR of what is correct to say, what can I say without getting a really harsh backlash. So yeah, definitely difficult waters to navigate.
All right, Red, thanks very much. Red Brown covers earnings for us on the BN side. I should point out, Dana, that
yes,
our producers in the control room have done some research. I always kind of joke about my 4-year-old daughter one day putting iPhones together, but it's not a bad salary. Apparently, Indeed.com has listings in Cupertino, California, $154,000 a year for Apple assembly technician. That's a pretty decent pay package, and I'm sure it comes with healthcare as well. So
I'm sure this country needs more of it. Part of the issue is that we've ceded all of that specialty to China. We don't have those specialized types of engineer, not just for literally assembling them, but the types of equipment that need to be made. So I think it is a valiant career path, Matt.
All right, let's take a look at futures right now. In terms of the S&P 500, we saw a huge drop, about 1% and change essentially when we got this second Trump tweet on tariffs, the EU 50% threat. Right now we're looking at a 1.5% drop, about 83 points to 57.70. Now this is the futures, but if you're looking at the cash trade and we drop below 57.70, that would be a drop below the 200-day moving average. The NASDAQ futures down almost 1.8%. Obviously, this affects the tech stocks more seriously because of the Apple threat, and then Russell 2000 off 2% and change. Coming up, Tesla upgraded on Musk's dedication to the company and potential for autonomous products, especially humanoid robots. This is Open Interest. Let's get now to high interest and look at what's making headlines around the world. Nuclear power stocks are rallying after a report that President Trump will sign executive orders that ease regulations for the sector. The report indicated that Trump will invoke the Cold War-era Defense Production Act to declare a national emergency over U.S. dependence on Russia and China for raw materials used for nuclear energy. And the Trump administration has blocked Harvard from enrolling international students. The move delivers a major blow to the school and escalates its fight with elite colleges, the administration's fight with elite colleges. Existing international students must transfer or lose their legal status, according to the Department of Homeland Security. And by the way, that's 27% of Harvard's student body. The blockade will increase financial pressure on Harvard, which has already had $2.6 billion in funding frozen and faces the loss of its tax-exempt status. Harvard obviously is calling this ban unlawful and is suing. OnlyFans owner Phoenix International is in talks to sell the company to an investor group at a valuation of around $8 billion. The London-based company, which hosts pornographic content forbidden on many other social networks, is reviewing a number of offers. According to Bloomberg sources, any deal for the website will have to overcome risks associated with hosting adult content, but they're trying to broaden it out to the mainstream. And Tesla bull Dan Ives is rallying up the herd. The Wedbush analyst raised his price target to $150, a new street high of, $500. That's his new price target, a new street high it would be. In a note this morning, he wrote, "We believe the golden age of autonomous is now on the doorstep for Tesla, centered around the success of its autonomous vision taking hold." The stock, however, is caught in this morning's sell-off. And joining us with more is Bloomberg's Detroit bureau chief, David Welch. So, David, what do we know about the drive for the stock valuation of Tesla? Because as Elon Musk told our Michal Hussein the other day, it's more than $1 trillion in total market cap. Is that driven by just making cars?
No, it can't be. First of all, the margins for making cars are just not that great. Tesla's growth is no longer there, right? They've got more competition in China. BYD has overtaken them. Sales down in Europe for a variety of reasons, partly competition, partly Elon Musk's politics. And, the company's struggling to maintain market share in the U.S., where you've got Hyundai, General Motors, and others selling more EVs now. Cadillac saying they're picking up some Tesla trade-ins these days. So he's not going to get growth just in the vehicles. And look, I love what we're seeing this morning with Ives' report, and then the fact that the shares aren't really reacting to it, because it shows you the entrenched sides of the Tesla bet. So Dan Ives is all in on the AI and autonomy bet, saying that they're going to get $1 trillion in value to Tesla alone for self-driving vehicles, robotics, AI. Market's not quite buying it yet. We'll see in June when Tesla really gets these vehicles out in Austin in earnest. But Waymo has been running self-driving vehicles on public roads and working on them for 15 years. Well, not all of that on public roads, but for a very, very long time. And they are very slowly, methodically moving into their 6th city. And so, they're not blitzing this thing because it's a very difficult problem to solve. Tesla's been running partially self-driving vehicles with autopilot and FSD, but those aren't truly autonomous systems. They're really driver assist that they've been running for most of the time.
Beyond the technology too, the thing that's really taken Tesla lower in the pre-market, which you can see that was Trump's tweet about tariffs. It wasn't anything about the company specifically. It also comes as a time when BYD finally for the first time surpassed Tesla sales in Europe. Does Tesla have a brand problem still, even with Elon Musk saying that he's pulling back from politics?
Well, they do. And look, there are a couple of heroic assumptions in Dan Ives' report. One is the $1 trillion for autonomy, but the other is that once Elon Musk leaves the Trump administration, or if he spends more time at Tesla, that the brand problem goes away. It doesn't. Look, his politics are pretty conservative, and that's his choice. I'm not making a judgment on that. But he routinely espouses that on X. So people who aren't going to buy his cars because of the politics, this brand issue that analysts have talked about, that's not going away because Elon is who he is and he believes what he believes. And if people don't like that, they may not buy his cars. So yes, you're right. I mean, you do have this issue on the vehicle side. But the main thing driving the Wedbush upgrade on Tesla is this autonomy bet. A lot of people have lost money going against Elon, but cashing in on autonomy is very difficult to do. It's always taken longer than everybody has thought. We were supposed to have self-driving cars all over the roads in 2020. It didn't happen. A lot of companies went bankrupt. So there's a big show-me aspect to Tesla and autonomous vehicles and AI.
I will say that I mean, not completely self-driving, but in a lot of the cars I test out, they do drive themselves for the most part, right, on big highway runs. General Motors has a system for that. I think Blue Cruise, Ford does as well. What about the robots, David? How important are the robots going to be for Tesla?
Look, I think it's a piece of this. They've talked less about it because we don't really know when they would come to a period where they're monetizing that, right? Elon has shown some interesting things on X that are kind of a lot of fun, and they served drinks at the event last year. But are they going to be getting to a point soon where that's a revenue and profitable part of their business? But look, it's all part of Elon's push that this is a technology company. It's not just a car company. And whether or not you think the stock's going to go to $500, like Dan Ives is saying, is whether or not you believe that argument. And I think that's the battleground on Tesla shares at the moment.
Hey, David, thank you so much for that update. That is Bloomberg's David Welch. Now, coming up, we get back to a market that's falling after more tariffs, or the threat of tariffs being announced by President Trump. Citi's Kate Moore argues that the S&P 500 is fairly valued now. She joins us next. This is Bloomberg Open Interest. Just a few minutes ago into the open, equity futures falling this morning after a 1-2 punch. First, a President Truth social post about Apple threatening tariffs, and then to the EU threatening 50%. Citi Wealth Chief Investment Officer Kate Moore joins us now at the desk. And Kate, I just want to flag Scott Bessent speaking to American media moments ago, saying that he hopes that the Trump EU threat would light a fire under the EU. When you look at these sorts of things, is it a negotiating tactic, or do you assume that these levels are coming?
I think we should assume, and let me just start back and say, I think many people in the market assume that 10% was the level that we were going to arrive at by the time we get to September, and that these reciprocal tariffs were not going to be a major issue. I think we should assume that ongoing tariff negotiations and threats are going to be the rule, not the exception. And so whether we're talking about Europe specifically, or China, or other countries, or very specific goods or companies, I don't think we're going to get past the point of pain by the time we get to Labor Day, which, in my view, was sort of being priced into markets.
Isn't this, just a continued gift to China and Russia? The fact that he causes this kind of global trade disruption for us makes them turn to them?
Yeah, it's certainly going to accelerate the realignment of alliances, of global trade, and relationships in a way that we would maybe not have forecast at the beginning of this year. I think what's going to be really important is to watch is that China needs to deal with a bunch of domestic policy as well. Like how much stimulus they want to give to the consumer, what do they want to do to kind of increase confidence for foreign investors looking at investing in Chinese stocks, but also critically, how much do they then want to spend outside of China to deepen these relationships, which we've seen them do in other points of crisis in the past, right? Whether it's securing resources, whether it's securing supply chains, whether it's partnering with local governments. So I'm going to be watching Chinese policy very closely over the balance of this year.
All right, Kate, we're going to keep you with us. Citi's Kate Moore stays with us through the open. We're going to ask her what she thinks of valuations even at these levels. And we could see the S&P 500, by the way, fall below the 200-day moving average. We are back with the opening bell next. This is Bloomberg. We are moments away from the start of trade on what looked like was going to be a pretty boring Friday. Well, it's not. Donald Trump took care of that for us. S&P futures down 1.25%. NASDAQ futures off 1.5% after he tweets out or truths out that Apple may face a 25% tariff and the EU may face a 50% tariff on all of its goods starting June 1st. You hear the opening bell on the New York Stock Exchange. I believe, once again, it is the United States Navy ringing the opening bell. Great to have these guys here. If you've never been to New York during Fleet Week, it's awesome. You've got so many sailors walking around, and you can thank them for their service. Also, I'm excited about sailing because of that dude who's sailing from Oregon to Washington with his cat. We're going to talk about that later. You've got some sort of SPAC ringing the opening bell on the NASDAQ. No one cares. In terms of the stocks to watch, obviously Apple is a huge one today because of that truth.
You know, I was also just thinking, do you think a lot of people just aren't at the office today because it's Memorial Day weekend, and then all of a sudden you have all of this to deal with?
Yes.
Probably the worst time if you're at a beach somewhere. Apologies to you. You're probably logging onto your terminal now. As Matt mentioned, Apple down 3% after the opening bell, facing pressure from Trump. He wants iPhones made in America, just as Apple reportedly was doubling down on manufacturing in India. He says, make it in America, Matt, or he's going to put a 25% tariff on the company.
Yeah, it'll be interesting to see how many iPhones are made in America, assembled in America, right, by the end of this term. It's something we've been talking about a lot on this program. Retailers are falling today after pulling guidance on macro uncertainty. This has really been a trend throughout earnings season. They say macro uncertainty, global trade uncertainty. What they mean, obviously, is tariffs. And as you can see, Ross Stores getting absolutely decimated, and Deckers Outdoor, the maker of Uggs and Hoka shoes, double that. So big drops after tariff threats or even the result of tariffs hurts the actual earnings outlook. Let's talk about that with Citi Wealth CIO Kate Moore. She's back here with us at the desk. And Kate, you know, this is all about stocks are a discounting mechanism, right? You're saying with the S&P trading at 23 times forward earnings, we believe that the market is more than fairly priced. And I have to say, especially since we don't really know what forward earnings are, right? Everyone's pulling their forecast.
Yeah, everyone's pulling their forecast. Actually, I just had a flashback a moment ago to the last time I was on this show. We were talking about pulling forward of demand. And I had mentioned that I pre-ordered a bunch of running shoes with the expectation that the prices for those were going to go up. So I have to say, I'm not surprised that we're seeing some of these consumer companies pull their guidance.
Are you a Hoka runner?
Yeah, I'm a Hoka runner, right. Yeah,
Okay.
I have an incredible stable of Hokas.
Nice.
Let's put it that way. But I think, when I go back to this earnings story, we've seen a large number of cuts from analysts, but the magnitude of those cuts is not very big. It's like death by 1,000 paper cuts. They want to signal that they know that there are headwinds, but they're not doing anything substantial because the uncertainty factor is so high. Are we at 10% tariffs? Are we at 25% tariffs? Does demand crater? Do taxes change people's consumption patterns? No one really knows. And as a result, it's hard to say that when we look at forward earnings, forward multiples, that they make sense.
Not to mention, Matt and I were talking about this earlier. If you're a company, if you're Walmart and you say, maybe I need to raise prices, you could get a Truth Social tweet, post, whatever, from the president saying you have to eat the tariffs. You could be Apple getting a message also from the president saying you need to bring manufacturing in the U.S. Just how difficult and unprecedented is this for companies to navigate right now?
I think it's incredibly difficult. Another area I'm watching actually is in terms of the labor force. We've seen very few firings or mass layoffs. People trim a little bit on the margins. There's a lot more sort of quiet trimming of labor force, but sort of the loud ones that we might see if people have expectations for slower growth, even tariffs accepted, haven't happened yet. I suspect some of that is because, number one, it is very expensive to rehire people if your forward estimates of growth are wrong. And number two, because no one really wants to catch the eye of the administration. They'd like to be as much BAU, as business as usual, as they possibly can. And so, I think there are lots of sort of behaviors that look a little bit different in 2025, given where we are in politics and policy.
I wonder when we see these kind of tweet barrages, and frankly, we see them every day. So it's not like the president has a strategy to change the news flow, but he does. Yesterday, we were so focused on one big, beautiful bill and the resultant deficits, right? We're expecting them to add $5.5 trillion to our already way too big national debt over the next 10 years. How much does that, to go back to that issue, how much does that matter to your to the work that you do at Citi, to your modeling, to these companies that you're looking at?
It matters a huge amount. I will say, in general, it feels like the market only pays attention to one thing at a time. And so today, It's tariffs, right? But yesterday, it was what is going to be the impact in terms of the overall deficit? What does this do to bond yields? But for us as multi-asset class investors and trying to invest our clients' money and advise all of our clients' portfolios, we're asking this question, which I think is a fair question. What is the balance? What is the hedge? What is the ballast? If bonds are, being impacted by one set of policies and equities are being impacted by another, and sometimes the correlation goes back to one, how do you construct a well-balanced portfolio that can manage risk? And I think as I talk to other asset allocators and other types of CIOs, on the street, we're all having similar debates, if I'm honest. And this is something I think we're going to be doing a lot more work on. But right now, duration, which has historically been a great balance and a great hedge for portfolios, doesn't feel that way.
We're not experiencing the kind of drops that we saw in futures, right, in the cash trade. Just to look at the market right now for a minute, we don't see the S&P 500 down more than 1%. We do, however, see yields coming back up. Yields had been diving this morning.
Yeah.
Josh Hartnett was out with a note. Michael Hartnett was out with a note, not Josh Hartnett.
I wish he had a market commentary.
on buy the dip, and it looked like investors were doing that.
Yeah.
And now those yields are coming back up. The 10-year back at 450, the 20 and the 30 back over 5.
But this is the thing. If we are concentrating back and forth between deficits and trade, it's really hard, Kate, to understand whether this is all good for duration or bad for duration. Because presumably, tariffs back on recession, I want to go buy bonds. But if it's recession plus higher deficits, can you?
Well, and let's take a look at the global picture here, too, because all aspects of this kind of also hinge on what international buyers and global investors might do, right? You know, if we are putting pressure on all of our trading partners, if it's a really difficult environment for global asset allocators, and they're asking this question, how much should we own in the U.S.? That's going to have an impact. So it's not just, you know, our own growth prospects or our own policy, but also decisions that global pension funds are making about whether or not they want to own long duration assets, whether or not they want to add incremental risk to U.S. equities, even if they're the highest quality in the world. So there's this other element that we're trying to factor in terms of positioning and sentiment and technicals, all while we're getting, you know, policy headlines one by one by one. This is what I will say. You know, we have been neutral on equities. We prefer to stay in kind of the large cap space when we can. I'd say that's like very close to benchmark. It's very conservative on that front. And I would love to be in a place where I could say, like, let's buy. It's time. I just don't see
That would be great for you and your job, wouldn't it?
It would be. It would be much better than saying, hey, like, hold steady. We don't want to add to risk right now, which everyone gets really tired of hearing me say. But it feels like the prudent thing to do for a, you know, diversified multi-asset fund.
Is there anything, though, that you love? Like, is there any strategy that you wake up and you're excited about? If somebody comes to you and says, Kate, I have to invest this $1 million now, what should I do?
Yeah. I'm an AI lover. I mean, that feels a little bit consensus, maybe a little bit less consensus than it was at the end of 2024. But I believe that any company that doesn't invest in AI and technology and software, training their people, is going to face, you know, an incredible threat to their performance and their competitive standing as we move forward. And so I believe this is going to be like a durable place of spend. And companies that benefit from that spend are going to have more consistent earnings in this period of macro volatility. So, you know, I get a little bit less fussy around valuations of these companies that have incredible tools and platforms, because I just don't think any individual or any company can afford to step away from making these technology investments in this environment.
You know, one trade I've heard, and I got to give Rob Armstrong at FT credit for this, it is the taco trade, which might be what we're seeing now, which is Trump always.
Tacos.
Well, I do love tacos, but Trump always chickens out.
Oh,
The
that's
taco
harsh,
trade.
though. That's harsh.
That's what they're calling it over at the FT, and maybe that's why stocks are down less than 1%. Tacos are delicious too, so fair
Right.
enough.
Yeah. I guess I'm going to have tacos for dinner tonight because now it's in my head.
There
Yeah.
you go.
There we
You're
go.
welcome for the dinner inspiration. Kate, thank you so much for joining us. Always wonderful to get your thoughts. That is Citi's Kate Moore. All right, let's get a check on some of the movers this morning. So, unsurprisingly, I'm going to say the ratio of stocks down to up is definitely going to be decisively down. That's right. We've got 458 stocks down. Only 45 of them are up. What's up this morning? You got a little bit of energy, a little bit of healthcare. I mean, United Health is up. That's considerable considering all the pain it's gone through, but those are your safety stocks. Let's go over to the other side. This is organized by points, so the biggest mover. It will not surprise you that Apple is the biggest contributor to the downside after that 25% tariff threat. Tech as a whole is down. Kate Moore just saying she's an AI lover. Maybe this is a great day to buy the dip. Tesla down, Visa, Workday, all of that under pressure. Now, when it comes to the sectors, most of those are on the red, too. Actually, all of them are in the red go. Just moments ago, utilities was up, but now that's being brought down. So every single one of the sectors, the things that are doing a little bit better, again, are your safety sectors, is utilities. The things to the downside, consumer discretionary. And on that point, Matt, we did hear from some more retailers. We're talking about this. Ross Decker's also flagging weakness, but also under more pain if they are going to face more tariffs, 50%. Yep. That's the threat from President Trump. Okay, coming up, as we've been saying, Trump demands made in America iPhones, a move that analysts say would take at least 5 years. We'll have more on that next on Bloomberg Open Interest. All right, let's get you some top calls. Some of the analyst action in focus this morning. First up, Canada Goose getting a downgrade to a settle at Williams Trading. The firm says that the parka maker has failed to evolve its brand. It says the company's latest earnings beat is thanks to colder than unusual weather and not any fundamental improvements. I literally saw someone wearing a parka yesterday in New York City, so not surprised. On that note, next up, Decker is getting a downgrade at Telsey Advisory. And let's be honest, a number of other Wall Street firms after their earnings, the maker behind Ugg boots, Hoka running shoes, they had a disappointing fiscal first quarter forecast. They also declined to provide full-year guidance, they said, due to the macro uncertainty, what we've heard from a lot of firms. Finally, Waste Management getting an upgrade at JP Morgan. The firm sees the defense growth sector as attractive given the risk of a U.S. slowdown or inflation pickup because, Matt, no matter what happens, recession or no recession, there's trash that needs to be picked up.
Yes, although a lot of times in New York, we just leave it on the streets for weeks and
Someone
weeks
picks it up.
and weeks. Apple is now valued at less than $3 trillion. Those shares off almost 3% this morning after President Trump threatened 25% tariffs if iPhones are not made in America. Wedbush's Dan Ives has noted that U.S.-made iPhones would be priced above $3,000. And joining us now is Bloomberg Intelligence senior technology analyst Anurag Rana. Anurag, first of all, great to see you. Good morning. Happy Friday. I'm sure you were excited to see this tweet or truth. How likely do you think it is that iPhones will be assembled in the U.S.?
I think they'll have to do something about it, maybe on the highest end. But I don't think after this tweet that Apple can basically say, we're going to, ship all the U.S. phones from India and not worry about any of this stuff. So I think they will have to go out, make peace with the president and tell him that we're going to spend the money on some other high margin items, whether it's chip and other areas. Because to be very frank, assembling a phone in the U.S. is not the best utilization of their resources. You're better off figuring out how to do much more higher end products. So I think they'll have to go out and make a peace with the president and figure out how to, get out of this jam.
Speaking of making peace with the president, Anurag, we saw in Trump 1.0 that some of the most onerous tariffs that would apply to Apple were pulled back because Tim Cook, or Tim Apple, as he was called at the time, had a conversation with President Trump. Do we understand whether those lines of communication are open at this moment?
Now, we'll figure out. We heard the president saying that there's all these CEOs that were at the Saudi Arabia conference and, Tim Cook wasn't there. He made a point to point it out. So I'm not sure what's happening behind the doors. But, at this point, he's made it very clear that Apple is not going to, move a lot of the phones from India, or he doesn't want them to, and wants them to make some of them in the U.S. Now, making them in the U.S. is not that easy because you need a massive factory to assemble these levels of phone. If you were to look at just the shipments that come into the U.S. every year, they are north of 60 million units. That is, Apple sells about 220 to 230 million units every year. So that's a very big portion of that particular shipment. So I think what's going to happen is unless they figure out a way to make peace, their market share in the U.S. is going to drop, and lower end Android phones are bound to gain some market share in the mid-end category because, obviously there is no way you can, sell a very expensive phone in the U.S. and still expect to maintain that high market share.
It comes at a tough time for Apple, Anurag. OpenAI teaming up with Johnny Ive to make something that you have to imagine would be better, cooler, more exciting than even the iPhone. And they really have fallen behind in AI. What do you see as the trajectory of this company's growth story?
See, when you look at it from the product side, they can license these products from other companies. So OpenAI is one of them. And I'm hopeful after the, really awesome demonstration by Gemini or Google or the I/O event, it's possible that they may actually do a deal with them as well in order to get Gemini on the iPhone. So I'm less concerned about they have the distribution system. So yes, they don't have their own LLM that's that good, but they can license that. My bigger worry on Apple on the near term is the App Store fee changes and the money they get from Google for the default search engine. That's a much bigger dollar amount and much bigger, impact to free cash flow than, frankly speaking, AI in the short term.
They get $20 billion a year from Google, is that right?
Something around that. They have not disclosed it, but that's what the reports tell us. And imagine that revenue stream comes with very little to no cost and falls most of it after tax to the bottom line.
Got it. Anurag, thanks so much for joining us. Anurag Rana there of Bloomberg Intelligence talking to us about one of the biggest stocks in the world that is shrinking. today. A check on what's going on in the markets. The S&P 500 is down more than 1%, just a bit. Right now at 57.78. Remember, if it falls below 57.70, and I don't put a lot of stock into technicals, but that would mean a drop below the 200 moving day average, and also, my opinion, counts for even less than technical analysis. NASDAQ 100 down 1.4%. The tech stocks are heavier, 20,812, the level there. This is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks here. We are seeing kind of a sea of red when you look at equities. Certainly the indexes are all down 1.1% on the S&P, 1.5% on the NASDAQ. I will say that you do see yields coming down, which means price up on bonds. And that's why you see these two green chiclets here. We're not looking at the kind of drop we had seen earlier. We're seeing the 10-year give up some of its gains in price, meaning the yield isn't down as much. Right now, it's back above 450, and the U.S. 30-year is back above 5. In terms of individual stocks, Tesla taking a hit, even though Dan Ives said it could be worth should be worth $500. Right now, trading at $336. So that's a long way from here. Apple down almost 3%. It's worth less than $3 trillion now. Ross and Deckers pulling their forecast because of tariff uncertainty. You see Amazon down 1.3% and Nike off as well. Those two are getting back together. They're going to sell Nikes on Amazon's website again. We told you that yesterday. But with this tariff news, it's going to be weighing on all of these retailers. Danny?
Yeah, but maybe some of the worst of losses pulling back after Scott Bessent, the Treasury Secretary, speaking to American media, saying, hey, there are a bunch of other deals in the works, and hopefully the EU post from Trump is just something to shake them awake. But regardless, it has been a really rough week for markets. The S&P down 3% for the week, on pace for its worst 5 days since President Trump's tariff announcement on April 2nd. Let's bring in Bloomberg's Jan Patrick Barnett on this. JP, I mean, what a week. Where do we start the push and pull? At first was taxes, now getting hammered by tariffs this morning.
Yeah, absolutely. And let's not forget about the rates play that also played a major role in the middle of the week. So it's definitely clear that the market is getting pulled in different directions. Also, we have a lot of short-term money in play, mechanical flows that are driving the market from time to time, or even from hour to hour at some places. And that explains why the market is so jittery. And I guess everybody knew that it's just a question of time until the next erratic Trump headline or Trump tweet or truth or whatever you want to call it is going around. And I mean, he has never been very fond of the EU during the whole episode of tariffs. So to me, it's not very surprising that he's coming out with this headline this morning. And I guess it's again just his negotiation tactics, if you want to call this. And I'm not even sure if this headline holds until Monday. But for the moment, it is what it is. And tariff uncertainty is still there. Market uncertainty is still there. And that's certainly not good for something if you want to have a quiet weekend.
There will be something new on Monday, for sure, out of the White House. But I wonder how different Monday looks in terms of yields. We're seeing a 10-year yield at 450, JP. We're seeing more than 5% on the 20 and 30-year. This makes financing a lot more expensive for companies as well as countries. How much does this matter to the stock market?
Well, that's an excellent question, and a bit very to answer that. I mean, on the one hand, it's of course, it's a major asset, and it plays a big role in valuation, and especially in the area that everybody loves in the stock market, which is long duration stocks, where you discount the long-term growth. So it plays an important role from a technical perspective. I mean, if it's so important, if we are at 5% or 490 or 510 or whatever, I'm not so sure. But I think the bigger issue for the stock market here is also we are again at the point where we wonder about the deficit in the U.S. And how this is going to be played forward. And this is coming up from time to time to time. And there's never really a solution. We just raise the debt cap, and then we keep on going until there's the next bill or budget coming out, and then we worry again about it. But at some point, it's clear that debt pile is unsustainable. It's a big problem for the financial system. And it speaks to the, I would say, overarching message right now that the U.S. is not in the best place as it used to be. And that's an issue for stocks as well.
Right. Definitely an issue, especially for foreign investors. JP, thanks so much for joining us. Bloomberg's Jan Patrick Barnett out of Frankfurt. Coming up after the break, SEC Commissioner Mark Uyeda joins the show to talk about, well, a lot of things, but we're going to focus in on tokenized equities and his team's priorities there. This is Open Interest. We are 30 minutes into the trading day and looking at a drop of more than 1% on the S&P 500 right now, trading at 57.79. The Nasdaq down 1 1/3. U.S. 10-year yield and yields really across the curve coming down, but not as much as they were earlier this morning. 450 is the level we're looking at in the 10-year, and it's going to be, I think they have a half day. In bonds.
They're gone at 2 p.m. And again, I said this before, how many people just decided to take off today, decide to go to what is probably a cold beach, and all of a sudden say, oh my gosh, I need to log on. Things are going pear-shaped.
Yeah, on the golf course, and all of a sudden your phone starts blowing up because we got a couple of tweets. I'm Matt Miller.
I'm Danny Berger, stepping in for Katie Greifeld and Sonali Basak this morning.
Yeah, and we're looking at, after a few tweets from the president here, we're looking at real moves. Fresh tariff threats. President Trump has announced a 50% tariff on EU goods and a 25% levy on Apple if the company doesn't manufacture its iPhones in the U.S.
That news adding fuel to the fire as investors head into a long holiday weekend. Stocks are having their worst week since Liberation Day.
And crypto also getting caught in the sell-off. We'll speak with the SEC Commissioner Mark Uyeda as tokenization of real-world assets goes mainstream. In fact, let's do it right now. That's today's Wall Street beat. The crypto exchange Kraken is allowing non-U.S. customers to trade Apple, Tesla, Nvidia, and other popular stocks as tokens over a digital ledger. We asked the co-CEO of Kraken yesterday how soon we could see this coming to the U.S.
The folks at the SEC have been extremely promotive of these types of ideas around how do we bring this to everyday consumers, how do we bring this to everyday investors. And so I'm pretty positive that we'll get to a place where we can start thinking about how to launch this. Again, not just with one company or one customer, but across the board.
I'm pleased to say that joining us now is SEC Commissioner Mark Uyeda. Commissioner, thank you so much for joining this morning. Now, I understand you just held a roundtable about this very issue. What are your thoughts on tokenization and the ability to do this, to trade equities 24/7 and have this new mechanism for it?
Yeah, well, certainly we've gone through numerous technological changes over the history of the stock markets. Remember, we were in paper, then we went to uncertificated securities, and then we went to what we have roughly today, book entries on various financial institutions. Now, tokenization is possibly another step forward in how we do the markets. You know, one thing that a lot of investors don't realize is the significant amount of resources that go into what they call the back office operations. That means a lot of reconciling between positions among financial institutions, DTC and SEC. So again, those are acronyms that hopefully most people don't know about because they do their job without anyone ever noticing that they're doing it right. So we've always been open to experimentation on this.
How would this work? I mean, is there a framework in place for approving or denying which tokens would be created, or are you in the process of putting that together? Who would be able to issue the tokens? I have so many questions about it.
Well, these are things that we want to engage with market participants. Exactly what do you propose to do when it comes to tokenization of securities positions? And more importantly, what type of safeguards are you going to have in place to protect investors and to guard against conflicts of interest?
Do we know how long it would be? We were talking with Mike Novogratz of Galaxy Digital a couple days ago, and he was saying in 1 or 2 months he thinks we could see it. Now, I don't know if he meant, foreign investors would be able to participate. Do you know how long it would be till U.S. investors are going to be able to, pick up their phones and, buy a piece of an Apple stock or Nvidia stock with a token?
Well, there are a number of things that we could do. It could take, if we need to do actual rules that have to go through notice and the comment and then are subject to potential review by the courts, that could be a lot lengthier process than what we do, what we call either sub-regulatory guidance, which basically means a no action letter or an exemptive order, or there's some other things that we can do. But again, it depends on whether or not what the proposals that they intend to seek are consistent with our mission of maintaining investor protection, fair, orderly, and efficient markets.
Now, elsewhere in this world, there also is a big push for stable coins. I know there's a piece of legislature making its way through Congress at the moment. There was also some journal reporting that some of the big banks are possibly considering doing their own. Part of the thing that the big banks have been worried about is stablecoins moving to other players and other players that are less regulated. Is that a concern for you if this is where stablecoins emerge from, not from the banking industry, which again already has some onerous regulation?
Yeah, well, it depends on whether that particular stablecoin even falls under SEC jurisdiction. We put out some guidance earlier this year which said a stablecoin that does not pay interest, does not yield dividends, or otherwise have a profit, it's not a security, because that is a fundamental part of what a security is. You have to anticipate making profits. Otherwise, a gift card could easily be a security. So stable coins that don't have that profit motive, not part of the SEC jurisdiction. Now, there is, I think, some interesting ideas out there. Can you create essentially a tokenized money market fund that one might be able to exchange? We do have rules on that, but that would be something that we would say, all right, what sort of safeguards do we need on here? Is this reliable? Do we know that it's going to protect, or at least they're going to appropriately safeguard and custody the assets underlying the fund? So that's a little bit different, but the whole banks versus money market funds has been something that's going on for, at this point, I think almost 4 decades.
By the way, I'm sure you read Matt Levine's Money Stuff, and he posits everything as a security, right? I mean, you can make everything a security if you want to go down that route.
Well, I think I thought his theme was more everything's securities fraud.
Yes, that's a good point.
That too.
Yeah. That's a good point. Everything's securities fraud. I got that wrong. Let me ask about the Trump coin ETF that right now is in registration. Is there any way that you would not approve that? Don't you have to? He's kind of like your boss's boss.
Well, we don't approve based on who is the boss's boss. What we do look at is we apply the same rule book that we apply to any other type of security that's being registered for offering on us. We are what we call merit neutral. We are a disclosure agency. So as long as we are comfortable that the appropriate disclosures have been made, there is no real legal basis for us to hold up a registration statement.
And meme coins, is that something you could see trading in ETFs?
Well, that's a very interesting question. We have had a number of types of financial products that have other types of non-securities assets. We put out, again, some guidance earlier this year that meme coins and NFTs are not securities. But if you put it into a big package, like some sort of collective investment vehicle, and then you sell interest in that, then the interest in that vehicle very well may be a security.
Can I just ask, Commissioner, because you're doing a lot of work on this. You're heading up a new crypto task force, too. We've mentioned just literally the tip of the iceberg of work that is being done in crypto. There's been reporting that SEC staff has shrunk by something like 15% so far this year. Has that made it more difficult for you?
Yeah. Well, first off, it's actually one of my colleagues, Commissioner Hester Peirce, who is leading the crypto task force. And that was one of the first things that I did when President Trump designated me as the acting chairman. It was, in fact, a day one issue was to put her in charge. I think she's got a fun little moniker as Crypto Mom. But to put her, because the issues of crypto are across all aspects of what we do at the SEC. So we've got a number of work streams going on that. And we've had already 4 roundtables with respect to crypto. This is something that we should have been doing years ago. And the reason why we do these roundtables and we solicit comment from the public is we want to make sure that we make informed decisions and we just don't come down through what I believe happened the last 4 years is what we call regulation by enforcement. I don't like something, we might not have a positive view of crypto, so therefore we're going to take an enforcement action against that. That's not what we do. We're supposed to be merit neutral.
I want to ask about something other than crypto. We're so focused on that just because of the news flow lately. But really, private markets have been at the heart of the discussion we have on this segment, Wall Street Beat. And it looks increasingly like retail investors want to get involved. And certainly, firms want to sell retail investors these products. So what kind of guardrails do you think the SEC needs to put in place as private markets become more prolific?
Yeah, well, our chairman, Paul Atkins, testified on the Hill earlier this year. He's very interested in getting more exposure of retail investors to private assets, but, and there was a very big caveat, he needs to make So there needs to be the appropriate disclosures. There needs to be the other safeguards in terms of financial professionals who recommend these and how they satisfy their fiduciary duties and their duties of care before they recommend them. Now, when I look at private assets, my perspective is this. Before I joined the SEC for 2.5 years, I was a state regulator for California. When I look at the asset mix that underlies my retirement in the California Public Employees Retirement System, with small slices allocated to venture capital, private credit, private equity, and then I think of myself, if I go now onto the marketplace and say, can I find a diversified fund that would provide exposures not only to public equities and public bonds, but also small slices of these other types of assets? You can't find it. So I think it's very important that we at least explore how we can make it possible so, as former Chairman Jay Clayton would call Mr. and Mrs. 401k, can have the same exposure that many of our local and state government employees have through their defined benefit retirement plans.
Are you not concerned about the liquidity mismatch? This has been a real problem for when it comes to retail, not just the educational, but should you want to pull it out, should you need access to it, which retail investors often do, that you could have something that looks like a run on these assets. Is that a real concern?
I think there's a big difference between the retirement market and the non-retirement market. What we've seen is the retirement market the assets tend to be what they call sticky. It's much rarer for people to pull them out early because there is also a tax penalty if you withdraw those assets early. And many times, especially for younger workers, if they have a 30 or 40-year investment horizon, some of these less liquid assets are much more appropriate than, say, somebody who has amassed quite a bit over a lifetime of savings in their 401k and now they're 70 years old. Their investment horizon may be much shorter and less appropriate for these types of private assets.
Very cool, Commissioner. Great to get to spend some time with you. I hope we can have you back on the show. SEC Commissioner Mark Uyeda talking us through a number of topics. Coming up next, JoAnne Feeney joins us, portfolio manager at Advisors Capital, how she says she's bracing for clouds on the horizon. This is Open Interest.
We are looking for opportunities to buy dip. 1%, 2% down is not much of a dip for us. If we see a 5% down, that's a different conversation. At the same time, we also have equity valuations that have recovered. We're at 21 times forward PE, above the 5-year average. So there's very little room here.
Nadia Level of UBS speaking earlier on Bloomberg. And by the way, a dip we are not having this morning if you want to use her metric for it. And many people's metric. Look at this, the S&P 500 and the NASDAQ are down, but less than 1%. And the futures trading at one point, the NASDAQ was down 2%. 10-year yields also only down by 1 basis point. The 30-year yield, Matt, isn't even down. It is unchanged at the moment.
It's fair. I mean, and we heard this from Mike Wilson, Morgan Stanley yesterday. He said, look, when I said buy the dip, I wasn't talking about 1%. I was talking about we think 5% is a dip, 10% is a correction, and then 20% is a bear market. I feel like those are Wall Street norms. I will say that if you look for the week, we're down almost 3%. So we're getting closer and closer to a dip. It's the worst week that we've seen since the week of April 2nd, Liberation Day, in which we had a real dip, basically a correction of 9%.
Yeah, and the dip at first started because of taxes. Now we've moved on to tariff concerns. But how much of a concern is it really if we're not selling off that much? Let's bring in JoAnne Feeney, portfolio manager and partner at Advisors Capital Management. JoAnne, it's kind of stunning to see the threat of 50% tariffs on the EU and 25% tariffs on Apple, and we're not even down 1%. What do you make of it?
Well, I think investors are looking through this a little bit and saying that we've seen these threats before, and we've seen them pulled back. There's a big negotiation coming up today with the European Union, and so perhaps that 50% threat was meant to spur them on a little bit and hopefully, get Europe to move first to try to send a signal that they're serious about negotiating reductions in primarily non-tariff barriers. But, we'll see. And then, of course, you have the Apple tweet or post that just makes no sense at all. You can't produce Apple iPhones in this country for anywhere near the cost of doing it because it's so labor intensive, and our labor costs 5 times more than China's labor.
By the way, what do you think, JoAnne, about the situation Apple is in right now? Because I was struck by the OpenAI purchase of Johnny Ives IO hardware designer company. It's not got any products out yet. They've never made anything. But when they do, OpenAI is a $300 billion company that's going to be making something we're all going to want to buy, right? Apple is a $3 trillion company, or was, that hasn't had any new products for so long. I just feel like there's room for those two to move in towards each other.
Yeah, well, what's interesting about that news from OpenAI is that in the same breath that they said they were, buying Johnny Ive and his firm, they also said that they want to work with all device producers to bring AI capabilities in whatever form. And, OpenAI doesn't currently have any devices, so they needed to do something, and why not get the best? I mean, clearly Johnny Ive has done great things in the past, and he's, I'm sure, got some great ideas. But Apple already has the devices it needs. It just needs to roll out AI capabilities on those devices in ways that consumers will like. And remember, Apple is always a second mover in these sorts of things. It waits to see what works and what doesn't work, and then they figure out how to do it most effectively and most pleasingly for the consumer. So, I don't think this threatens Apple. I think we're going to see more from them. We heard a story yesterday that they're going to roll out more lightweight, more streamlined glasses of some sort to bring OpenAI more directly into the consumer's brain.
I mean, it's a really tough time for these companies, JoAnne. You have to commit capital at a time if you don't know if you're going to be forced to completely upend your supply chain. But that's kind of not what we got from these big tech players. CapEx is alive and well for the hyperscalers, for the FANG, for the Mag 7 stocks. I don't know if anyone says FANG stocks anymore. Yeah, that's a blasphemy.
It's MOG now, apparently.
What's MOG?
Meta, OpenAI, Google.
Oh, that's good. I'm sorry for putting you on the spot, but you nailed that one. So, JoAnne, the MOG stocks, they're all still spending like crazy. Is this the way forward? Is this what it carried us out of the dip in April? Is that what continues to propel this equity market higher?
Yeah, so I think it's important for investors to understand what it is they need out of their portfolios. So I co-manage our growth strategy. I manage our balance strategy, and that's a very different, set of groups of investors, different places in their lives, different needs for cash flow, for example. So, but I've been telling both groups, and we actually had a conference this week with all of our advisor partners, and what we told them is, if you have clients who are older, who really need to protect principal or be more conservative, there's a good balanced strategy to do that, but you don't ignore the growth opportunities. And you just pointed out some very resilient growth opportunities, generative AI, but there are others, cybersecurity, demographic changes, and you can still own some growth and be pretty much out of the line of fire of these tariffs and other policy uncertainties. But that doesn't mean you need to go all in. You have to keep that balance with maybe perhaps some more conservative income generating opportunities. And that's where, to your point, Dan, that's where they're spending the CapEx. That's redundant. That's where capital is being spent because they see growth opportunities. But look across the rest of the economy, industrials, healthcare, elsewhere, right? They are pulling back on spending plans because of the level of uncertainty that they face. 50% tariff on Europe, this would be devastating for a lot of manufacturers, a lot of service companies that need inputs from Europe.
I appreciate your syntax self-regulation. JoAnne Feeney of Advisors Capital, real pleasure having you on today. Hope you have a fantastic weekend. Still ahead, more on Apple as President Trump sends a message to the tech giant. Make the iPhones that you sell here in America. This is Open Interest. More now on Apple as President Trump threatens a 25% tariff on the company if iPhones are not made in America. Joining us is Mandeep Singh, who leads our global technology coverage at Bloomberg Intelligence. Mandeep, it's a fantastic story, right? But how likely is it that Apple actually assembles iPhones in the United States?
It is a very far-fetched scenario, and most likely it is a negotiation tactic on the behalf of President Trump to, have Apple really speed things up in terms of setting up operations, because we have seen, Project Stargate and some other AI infrastructure being set up in Texas. So the question I think that will come up is, why can't Apple do the same when it comes to their assembly? And look, in this case, iPhones, about 30% of those are sold in the US. So that could easily be a $10 billion hit to Apple's free cash flow if the 25% tariffs are imposed. So, with that being said, I think it's in Apple's interest to diversify their supply chain. They were already doing that in India, but apparently India doesn't suffice anymore. So they may have to, take specific action in terms of starting building something here in the U.S.
But if they do that, Mandeep, presumably that's going to take years. Or is the assumption that just even starting something here in the U.S. might be enough to alleviate some of the pressure from the White House?
I think so. And look, I go back to, what these companies are doing in terms of AI infrastructure. I mean, we have seen, I think there was a Bloomberg story that showed, the kind of buildings that are coming up for these big AI infrastructure GPUs. And so that tells me, there is obviously the supply chain being moved on the server side for the data center capacity that is being built up there. Obviously, the smartphone supply chains are different, and the suppliers are probably more than that on the server side. But there is a case to be made that, you could see some definitive action in terms of setting up assembly facilities here. I mean, obviously, the price point will be very different. The gross margin profile of the phones made here and sold here would be very different. But I think that's what the administration is looking for here.
All right, Mandeep, great talking to Mandeep Singh there from Bloomberg Intelligence on Apple. We come back, we'll talk about the holiday weekend travel with James Ferrara. He is the CEO of InteleTravel. This is Open Interest.
The biggest issue I think that Wall Street's been struggling with is, are tariffs leverage to get a deal, or are tariffs revenue? If they're leverage, I think most people on Wall Street would be fine with that. To get a deal, to use them as leverage to lower tariffs, open up trade. But are they a form of a tax on foreigners to try and raise revenue? That has been the bigger issue that we've been trying to struggle with.
That was Bianco Research founder and Wolverine, Jim Bianco, speaking earlier on Bloomberg Television. Joining us now is Scarlett Fu, co-host of The Close. And Scarlett, he was answering a question from John Farrow in response to how do equities deal with this Trump tweet, right? And so far we've seen them down, but maybe not as bad as could have been expected.
Well, you still have the rest of the trading day to go. So there's that, and we've seen a lot of movement. One thing to keep in mind, though, is on Fridays, there's a lot more trading than there ever used to be. It's a lot busier during this Trump administration than it was, say, 4 years ago. Bloomberg Intelligence crunched the numbers and found that the equity trading is up 42% versus 4 years ago, and the average number of shares traded is up 37% versus 4 years ago. No one wants to be too exposed, too long, too short, too anything heading into the weekend, because you just never know whether the president will make some stray comment or post something on social media.
That's so unfortunate, because it's a long weekend. So you obviously, if you're going to choose a Friday not to be here, you'd probably want to choose literally this Friday.
Well, if you weren't here this morning, then, joke's on you, because something big happened this morning and people are reacting to it.
Well, nobody wants to be long over the weekend, right? Farrow was joking with Nadia Lovell this morning about how great it is to be here and not have to defend a bullish call because she came on bearish. I'm sure if you took today off, if you're out at Bethpage Black, right, working on your handicap, you sold yesterday. You went into this neutral, so you're very happy.
You think so?
Yes.
Well, otherwise, you interrupt your golf game, or you got your phone out, you bring a laptop with your terminal, and then you quickly do some hedging bets.
That's no fun for anyone. Well, here's the other thing also. I mean, we have a week in which everyone's fixated on the 20-year bond auction on the Wednesday. When was the last time anyone paid attention to the 20-year bond or the bond auction for the 20-year, right? I mean, that just speaks to how on edge investors are and how they are looking for some kind of indication of demand, indication of the resilience of these auctions in terms of how many people might show up. And that just speaks to, again, people are looking for something to hang on to.
Can I just say, though, it might be a good idea to actually be on the golf course and to not really care about what's going on. Because, again, you see stocks sell off really viciously in the future session. They come back. Bonds, the 30-year yield isn't even down this morning. It's back higher. It's like we've completely ignored everything. Scarlett, there does feel to be this strange resilience in markets, that it's gotten Fed headlines about a Moody's downgrade, that there's a tax bill going.
Is it
through
an
DC.
extraordinary complacency as
or is it retail
Jamie Dimon
investors
said?
being trained over decades to buy the dip no matter what, and they come in each time? So maybe it's the institutional investors that are reacting quickly and the retail investors who say, you know what, I'm coming in because it's always worked
strategy.
Yes. Trump always chickens out, by the way.
Yes.
Oh, that's what it's called?
I love
taco
taco trade, yes.
We are looking for tickets to Mission Impossible as a team. Because Tom Cruise is putting out the last one. And what's the deal? He apparently got an actual aircraft carrier for it?
The USS George H.W. Bush on loan from the Pentagon to Tom Cruise and his producer so that they can film these incredible scenes. Ethan Hunt's doing something. I'm sure Tom Cruise is running really hard across the aircraft carrier because that's what he does no matter where he is. I did not see the second version of Dead Reckoning. I tried to watch the first one, and it's like 3 hours. The first 1.5 hours was really good, and then when they started explaining everything, I lost interest.
I have time for Tom Cruise.
Dude, the man is so fit. You're so right. How's he doing these scenes? It's incredible. I thought you were going to say the team's trying to get tickets for the Knicks game, and I was like, good luck.
No, that's at 8 o'clock tonight, right? And
Yes.
they lost in a heartbreaking.
So sad.
Danny watched.
I
was
did
obviously asleep.
watch, and I regretted it. I mean, how can you lose? Timothy Chalamet, Larry David caught the ball on the sideline at one point.
Spike Lee, how can you disappoint these guys, right?
I know.
Well, go to Indiana and get tickets for a lot cheaper there, like a third of the price that you would at the Garden, and maybe you'll see the Knicks prevail in Game 3.
There you go. Scarlett setting up your travel plans for the Knicks. Scarlett, thank you so much.
Go to Indianapolis.
Go to Indianapolis is the overriding
Don't
message.
fly out of Newark.
Oh, no.
I'm sorry. I'm sorry,
news,
Danny.
Bad news for me. Speaking of flying out of Newark, we can get to that in a moment, but more than 45 million Americans are set to hit the road for the unofficial start of the summer Memorial Day weekend. Kayak CEO Steve Hafner spoke to Bloomberg this morning.
Memorial Day weekend is upon us. It's a playoff game for the travel industry. It's not the Super Bowl, that's Thanksgiving, but gas prices are down, so you're going to see about 45 million Americans hit the road. Airfares are actually down too. So if you look at kayak data, domestic airfares are down 7% from last year. So airports, maybe not Newark, but airports are going to be full.
That was Kayak CEO Steve Hafner speaking to Bloomberg earlier. Nobody's going to fly out of Newark, right?
Who would do such a thing?
That?
Who would do something so crazy?
For more on what travelers can anticipate this weekend, we're joined by James Ferrara, InteleTravel CEO and co-founder. James, all joking aside, how much reorganization do you see of this weekend in light of the dangers that we've recently been made aware of?
Well, first of all, good morning, and I have 10 flights in and out of Newark in the next 30 days. So this is no joke. The market is incredible. You used the term resilient earlier today. Is incredibly resilient, even given the headwinds, the economic pressures, the inflation, if it exists, the geopolitical pressures. Travelers seem to be sticking with their priority, which is travel. So we are setting a record this weekend, and the record is quite old. I don't think people realize it goes back to 2005, and we're expected to surpass that. And also interesting for airfares, and Steve is right, but if you look at the long term, let's say the last 30 years, and you adjust to today's dollars, airfares are 35% lower now.
That's amazing because we have all of this economic uncertainty. You know, in the markets, we're talking about tariffs, we're talking about deficits. We're not talking about inflation, and it's interesting that the prices are down that low. What's driving so much travel here, James? Where are people going?
Well, and there is an adjustment to domestic travel. I will say that because of the geopolitical situation and the fear of reprisals on tariffs and a couple of other, border issues, people are staying closer to home. And that's traditional with Memorial Day anyway, right? Mostly people go to the beach. I'm out in East Hampton this weekend. I highly recommend it. But there are some new things. I've noticed some really strong trends. Universal opened Universal's Epic Universe just this week. And we're seeing really strong bookings down to Orlando. And another one that I love is a new cruise line in its inaugural season this year up in the Great Lakes. It's called Victory Cruise Line, and it is the only cruise you can take that visits all 5 Great Lakes. So a really American thing to do on Memorial Day weekend, and we've had strong bookings for those kinds of new domestic opportunities. Also, you could go back to the roots of the holiday and the meaning of the holiday, perhaps. People do go visit their service members in military cemeteries around the country and other resting places. And there's even a wonderful sort of volunteerism opportunity called the Honor Project for families who can't get to visit the graves of their family members, their service members. You can do it for them through the Honor Project. So love that.
James, I love that idea. And
I'm going to Fredericksburg.
You are going to Fredericksburg. There's a lot of like Civil War things to see there.
Yes, that's right.
Absolutely. Yeah, so very American things to do. James, can I ask literally the polar opposite of that? There has been this idea that less people internationally are coming to America because of harm to the brand America and whatnot. It's also a bank holiday, a long weekend in the UK, by the way. Are you seeing those trends? Are less people actually coming to the US from internationally?
Absolutely. I mean, the real, the bloodbath is Canada, right? So there's been almost a 50% decrease in what we call international visitation from Canada. The UK, not so much. They seem to be a little hardier stock, but still, 6-7% off. Other countries in Europe, though, 20% and better. Countries like Italy and France. So it's a real thing.
James, before you go, I need to just ask you bluntly, because we've been dancing around it. I am the one who has a flight out of Newark today. Can you just let me know that that decision was an okay one for me, that I kept my flight?
Are you a gambler? I'm doing pretty well. Statistically, I'm doing very well. I fly in and out of Newark almost religiously. Delays, okay, I can live with delays. Cancellations are a horrible pain. So far, I'm doing well. I think they got the memo and they pulled back. Some flights are being canceled, but with notice, so, weeks ahead of time, and they're trying to trim for the summer. And I think with all the pressure on them, they're going to get this fixed. It hasn't been as bad as the reports.
Are you a gambler is not the response I wanted.
Not when you're flying. James, great talking to you. Thanks so much for joining us. Have to have you back on the program. James Ferrara there of InteleTravel out of East Hampton, where the high this weekend is expected to only be 67.
Oh, that's a bummer.
I don't know if it's a beach weekend, but it's nice to be there when fewer people are. In terms of traveling, I've really been focused on sailing because there's this kid, or I guess man, on Instagram. Yeah. His name is Oliver. He got a diagnosis about a spinal problem that he had, which could lead at some point to paralysis, and that led him to totally reevaluate his corporate life. He had a 9-to-5 that he absolutely hated, and he decided he was going to quit his job, cash out his 401k, buy a sailboat, he had no experience, and then sail by himself around the world. The guy's
not by himself.
Well, true.
His cat.
With his cat, Phoenix, and that's I think his handle on Instagram, Sailing with Phoenix or TikTok or whatever. The cool thing about this guy is he has attracted 1.6 million followers on Instagram, and he's kind of a socially awkward dude that's super endearing when you watch his videos. And now he's like the most popular man on social media. He's apparently going to land in Hawaii tomorrow. So he's been on the sea for 23 days out of Oregon, and tomorrow he arrives somewhere in Hawaii. I'm so excited for him. Everybody's tracking him.
After this week, everybody's going to want to do that. After the week we've had, everyone's going to be like, I like this guy. I, too, am going to liquidate all of my holdings and go sail around the world.
I wonder what kind of hit he took. You can't just liquidate your 401k if you're under 65.
There's a tax implication to it, but maybe that's, I don't know, a more calming way to spend your time.
In any case, very cool, Oliver. We're all rooting for you, and good luck. Coming up, we head to Washington, D.C. next. I'd rather be in Hawaii, but President Trump is recommending a 50% tariff on the EU, 25% on Apple. There you see him with Ursula von der Leyen. This is Open Interest.
Let's get back to our top story. President Trump has recommended a 50% tariff on EU goods. This morning, he said the European Union talks are going nowhere, and his administration will look to implement the steep duty on the bloc starting next Sunday. Joining us now is Bloomberg Balance of Power co-anchor Kayleigh Lyons. Kayleigh, it was supposed to be a quiet Friday. Things have not turned out that way.
There's no such thing in this White House as a quiet Friday, Danny. I think we've all learned that lesson. While things had been quieter on the trade front, we had heard from President Trump actually a week ago Friday suggesting that in the next couple of weeks, the U.S. may be setting tariff levels, just telling countries what they have to pay to do business with the U.S. in the absence of negotiations making progress. And it does seem that that is what we are seeing evident for the European Union here as he's floating this 50% tariff going into effect on June 1st, saying that the Europeans have been very difficult to deal with. And once again, airing familiar grievances around not just their tariff barriers, but non-tariff barriers as well, like the value-added tax and other measures. And so he is threatening this. I would point out that Scott Besson, who's going to be on Bloomberg TV just about an hour from now, did say on another network today that the European proposals are just not of the same quality in terms of trade proposals that we've seen from other trading partners. And he said he hopes this threat lights a fire under the EU. So it does seem that they're leaving some room here for this to just be another negotiating tactic. You threaten the higher tariff, see what they come back to, potentially with more agreeable terms. Certainly, we have seen that time and again in this administration, that a threat is made and then walked back. I would just point out, though, that for the European Union specifically, Bloomberg had reported earlier this week that the Europeans were characterizing the asks, the wish list from the administration here as being unilateral and unrealistic as they are looking for tariffs to be lowered, yes, but also changes to those non-tariff barriers I mentioned, keeping in mind this is a multi-nation bloc the U.S. is trying to negotiate with here, which makes it more complicated than some of just the one single country to single country negotiations that are also still ongoing.
I've been pointing out today that the VAT, the value-added tax, isn't really a non-tariff barrier. Everybody has to pay that, even stuff that's made in Europe. It's charged on that. It's like a sales tax. If you buy something in Florida, you pay a 6% tax. If you buy something here in New York, you pay 7 or 8% tax. So that's just, I think, a misunderstanding that the president has. I think it's interesting that these tweets came out and kind of take our focus off of the one big, beautiful bill that you and Joe were talking about so much yesterday. And so I want to bring our focus back to that. First of all, how much is that one big, beautiful bill going to increase our national debt? What's it going to add to our national debt over the next 10 years if you take away the accounting tricks that Congress has tried to skew the picture with?
Yeah, Matt, it depends on what estimate you're looking at, but trillions of dollars is the answer, basically, no matter what. The Congressional Budget Office said the revised legislation could add upwards of $2 trillion to the debt over 10 years. But also you have outside institutions like the Committee for a Responsible Federal Budget that say if some of these tax cuts are made permanent, which is actually a change the Senate, by and large, would like to see. They want to see these being for permanent, longer duration than the House. That could raise the price tag ultimately to well north of $5 trillion. So the deficit is likely to go up as a result of this legislation, even if the Senate's accounting practices that you were alluding to, using the current policy baseline, would suggest that it is not going to be that much. This is still going to add to the debt burden of the United States. And that's why some senators, including the likes of Ron Johnson, for example, are saying they cannot support this legislation as it currently stands. They are looking for steeper spending cuts. Other senators take issues with this legislation as well, be it the faster rollback of clean energy subsidies from the Inflation Reduction Act, some of the changes that were made to SNAP and Medicaid benefits and who is going to be able to claim them. So this package that passed the House very narrowly yesterday could look very different once the Senate finishes its work on it and sends it back to the House. Of course, the Senate has set a deadline for doing so of the 4th of July.
Kaylee, Balance of Power is always must-watch TV, but it is even more so today. We're really looking forward to it. Kaylee Lyons there. Tune in to Balance of Power. That is at noon Eastern time. Another must-watch segment of TV is going to be coming up in the next hour. We're going to be speaking with U.S. Treasury Secretary Scott Bessent. That's at 11:30 a.m. New York time, Matt.
I will say Balance of Power, so it's the radio show starts at noon with Joe. Then on TV, it's at 1 o'clock.
It's a lot of Balance of Power
when Kaylee
fix,
joins, and then again at 5 p.m., which I always feel horrible for her having to stay so late on a Friday. But that's why we love her. Up next, Trump Media is coming for your brokerage account. We'll discuss the president's company and its ETF plans in our ETF Friday. This is Open Interest. Trump Media is coming for brokerage accounts. The Truth Social parent, which is majority owned by the President of the United States of America, plans to sell investment funds that will potentially benefit from the policies of the President of the United States of America. With bets on energy, crypto, and domestic manufacturing, joining us now is Bloomberg Intelligence ETF analyst James Seyffert. So, James, what do we know about this plan?
Yeah, I mean, so it sounds worse than it is. I mean, a lot of these funds that they would come out with, they already exist. Other issuers have launched them. It's just a bad look. A lot of people have issues saying there are issues with these ethics. I mean, Trump probably isn't involved at all in any of the day-to-day processes here. It just doesn't look great. But one unique thing here is they actually haven't technically filed yet, as far as we're aware, at least not publicly. Usually you file and then you go into a quiet period and you can't talk about the filings until the SEC approves them. They go through certain processes. They've gone out. We saw some rumblings of this like many months ago. Then there was a press release that they were going to do this. And yet still there's no official filing. So we don't exactly know the details of what's going to go on here. But a lot of these things that have been filed specifically, like we have ETFs that exist that are already doing this. We have reshoring ETFs. We have Bitcoin-related ETFs. You know, these are all things we kind of already have. But this just goes back to a further thing, like even in the crypto industry, which we can get into if you want. Like Trump is leaning into this space maybe a little bit too hard on the personal side of things.
I was going to say, James, Matt asked the SEC commissioner earlier in the hour exactly that. Things like the ETF, do you got to approve it because the man is essentially the big boss. He's your boss's boss's boss. And his answer was one that you'd expect. It doesn't matter who owns it. We view all of these the same. James, is that really the case, or is the SEC likely to face some political pressure?
Yeah, I mean, I kind of, when you ask that, I think immediately to like the political pressure that he's putting on Jerome Powell. But I do think the SEC, they're just going to go back. They're going to come up with clear rules and regulations, rules of the road, if you will. So the question is like what ETFs are going to get through, particularly on the crypto side of things. I mean, obviously, there's been filings for a Trump coin ETF. We know about the Trump dinner that just happened recently. Melania coin ETF has been filed as well by some issuers. So there's a lot of things on here. But what I always go back to is like things have gone from, we had a pendulum way over here with Biden and Gensler, where they were against this entire space. In our view, it was way too harsh. And it was like, okay, Trump's going to bring things more back to the center. It's going to be more midlined. And honestly, with the things that have happened over the last few months, since even before the inauguration, since the election, you know, it's kind of swung too far to the other side. It's almost too much, and more so than people even want, no matter how you're looking at this. So again, it goes back to, is there anything adamantly wrong about what's going on here? No. Does it look bad? Yes. Is it giving ammunition to, you know, the left wing of the Democratic Party to say that there's bad things happening? For sure. So that's the way that I see it.
Welcome to the Wild West, James Seyffert of Bloomberg Intelligence. James covers the ETFs for us, and really one of the strongest, I have to say, one of the strongest teams at Bloomberg. Is that fair to say?
I think it's absolutely accurate.
With Sarah Fagas and Balchunas. Thank you very much, Danny, for a great day. Have a fantastic weekend. Good luck flying out of Newark.
Pray for me.
In the next hour, Treasury Secretary Scott Bessent.